Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is Deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest Podcast. Let's get started. Stas Sukhinin has over 19 years' experience in finance, spanning investment banking, corporate lending, and alternative asset management. He began his career at internationally recognized institutions, including UniCredit and Societe General, where he helped pioneer mezzanine loan products and shaped the market in Eastern Europe. By the age of 29, Stas has become a senior partner at one of the region's largest mezzanine lenders, managing a team of 20 finance professionals and overseeing $450 million loan portfolio. He later served on boards of several private companies, deepening his expertise across credit, investments, and corporate governance. Recognizing early opportunities in alternative assets, Stas joined a crypto investment fund at its inception in 2017 and continues to lead its strategy and operations. Stas, welcome to the podcast.
Yeah, thank you, Corey. Thank you for having me. Yeah.
So listen, Stas, I want to get into all your background as a as a deal maker, and you've seen it from a number of perspectives: investment banking, lending, what you do now in alternatives. But before we go there, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old. What did you want to be? Because I'm guessing certainly somebody in the crypto space, in the alternative space, even doing any of these deals as an investment banker or a lender. I'm guessing that wasn't on the radar back then, but you tell me.
Yeah, no, I kind of I was interested in numbers and financials. And I remember I was 14 years old and I read my first a business magazine. I remember one of my classmates brought a business magazine and I started reading it and I realized, okay, there's the world of business and there's business owners and they making millions selling their business. And I was fascinated by this and I said, okay, I need to work something with the business. And I quickly figure out that I want to be in a corporate lending department because I can see the business, I can see their financials, I can speak with the business owners. And then on the other side, I kind of working with numbers, I working at the bank. And it's actually what happened. So I land a junior credit analyst, my was first position. Then I start working with really small businesses with no financials. Then I start working with mid-sized businesses, large corporations, and kind of progress from this. Yeah.
Love it. Love it. One other question looking back, what was your first deal of any type? It could have been early in your career or maybe even when you were younger. I don't know.
Yeah, I think the first, in terms of lending experience, it was really interesting. We finance, it was a real estate development. And I think they were a lot of these kind of a transactional things and how we structure a deal because it wasn't typical transaction at the bank where I work. And we kind of trying to put additional kind of security measures, make sure that the deal goes in the right direction. And it was really interesting because we match the disbursement that we provided on our credit facility, matching the sales on this real estate project. So they basically building and selling, and we kind of make it portionally in line with how we credited this project. So it was a really interesting experience. It was maybe not 100% transaction, but it's interesting way how you structure the real estate development deal.
Yeah. I mean, that is interesting because you see, how do they underwrite those deals? What are the triggers for release of certain funds at certain times, right? And then obviously, especially with development, if they're turning over and selling properties, right? What are the financial covenants? What are the triggers for release of funds, right?
Yeah, and I think it's it's very interesting to, like, a lot of business owners don't see it, how deals discussed at the credit committees, investments committees inside. And I can tell you, it's quite an experience. It's kind of like, it's not what you see in the movies, or like what you like. I don't think, like, if you ask a ordinary business owner depicts like how they think it's happening, and it's what's actually discussing. I think it's like two completely different worlds. Yeah. So this, like, certain things, like, for example, sometimes it's just, is it kind of in line with our credit policy? Or like, if it's a big deal, for example, this can be, okay, it's going to be sizable size in our portfolio. Like, do we want to see, like, these are certain, sometimes strategic thinking that I don't think, like, business owners, like, when they apply for the credit, they don't really think about it, right? Like, and these are certain things that you would never think about it, but like, yeah, it's
So these factors that are unrelated to the specific underwriting of that specific deal.
yeah, especially if it's a large deal. Like, the larger the deal, like if it's an investments or even like a lending, if it's like a tens of millions of dollars, it becomes less as a systematic approach and less kind of like bespoke underwriting and like in different factors. Like, I don't know, they have a competitor in the lending portfolio. Oh, it's maybe not even lending. I know they use, like, I know, receivable financing. It's not maybe different department, but it's like the biggest client of theirs, and they probably don't want to finance the competitor. And you maybe don't even know about it, so like you wouldn't think about it. And like, there's so many like small things that can kind of like affect the decisions of large financial institutions.
And they're not necessarily, even when they come, let's say they reject the loan opportunity, they're not necessarily disclosing to you all these reasons that might have been behind the scenes, right?
Yeah. I remember like this mistake. So like, working, there was another junior senior analyst, and the client called. So the client asked, like, he said like, yeah, you've been rejected. And he said like, who voted against? And he's like, he made this huge like rookie mistake. He sent our internal memorandum, who voted how. And yeah, to the client. And this was like, yeah, like, he definitely, yeah, it's kind of, sometimes they can say like, oh, it's not part of our portfolio, but usually you're trying to sort out, like, I know my approach was like, your criteria, you're not going the deal to the credit committee if it's not part of your strategy.
Right. Yeah. Because when you're internal there as well, I'm sure, I would guess, and, I've heard from others that, like, for your own job, like, if you present too many loans that aren't appropriate to the credit committee, it's not going to look good for you.
Yeah.
Right?
Yeah. You should be very thoughtful about this, and like, understand like what is doable, what is not. And and you kind of just get it after you, I don't know, like, you work at least, I don't know, half a year with actively presenting deals, opportunities, and then you kind of understand it.
Yeah. So, but even in that case, when you would present, like, so, let's say you put in your time, you're really clear, you're really very good at submitting stuff that aligns with the criteria. It's sounding to me like what you're saying is sometimes there are still other reasons why, the credit committee might make decisions. It's within criteria, but there's these other factors that come at that level, right?
Yeah, it really depends. Sometimes like those committees is not efficient, especially at the banks. They're bigger ones, and like, if you have more people, it's less efficient. And then you have like people that not really directly involved in these lending activities, and they're not really like sometimes they don't know like about clients anything. It's just like, and they make the assumptions, I don't know, like, oh, I heard like this company, like, I know whatever they're doing, like, there's a competitors and they recently filed a bankruptcy, and then they make assumptions that the entire sector is kind of like, is not investable right now, but they can be like 100 other reasons why it's filed bankruptcy. But as it's kind of like put it, it's like, you're prepared for this committee. There's in large banks, in large financial institutions, there's a risk department. They preparing this, like, they resume, like, they review the deal. You presenting your review of the deal, and then like one comment from one member of the committee kind of changed the trajectory of the conversations, right? And it's like, and then maybe even you approve like after these comments, but like they say like, oh, it seems like this sector is kind of like high risk. Let's charge this client higher interest rate than we usually charge. So it's like, it can come up like that.
Yeah. So right, they might approve it.
So it's literally one comment from from a person that not really involved in anything and not really like read all these memos, because those memos like from risk departments, they usually like, I don't know, 10 pages, 20 pages, 30 pages. So they're really long.
Yeah, and it throws out, and like you said, even if they approve it, maybe it's a less favorable terms, higher.
Yeah.
Interesting. It's funny. It's sort of just a little, it's not the same thing, but a little parallel. So I grew up in New York, and in New York City, and when people would apply to live in a co-op, right, you had these co-op boards, and the co-op boards would reject people sometimes, and they never had to give a reason. And people would be like, wait, my financials are great. I'm, I don't have any criminal background. I have a good job. Like, why did I get, rejected? And there's all kinds of dynamics that go on behind the scenes, some of which might be legitimate, some of which, frankly, might be discriminatory or otherwise. But the co-op boards never had to disclose their reasoning, and certainly not who voted which way. So, it's funny. It's kind of parallel.
Yeah. It's like, I don't know, like the best practice is still, especially if like it's a larger client, you like you're trying to explain why it doesn't work, like what they can improve, or like there's too much debt, or like there is a risky profile, or like they need, I don't know, like, you're trying like to provide useful advice, but sometimes the reason is so absurd so that you cannot just deliver it straight.
I love it. So listen, between all of the lending experience you've had and, your experience on the investment banking side, you've definitely gotten a feel for, yes, there may be these quirky reasons or these one-off things or these, but, just to increase the chances that a deal gets done, whether it's a sale, whether it's getting a loan or raising capital, what are some of those critical sort of financial decisions or things that companies do right or companies do wrong to put themselves in the best position to be either fundable or saleable?
Yeah, I think sometimes like there's a timing and the wrong instrument. Sometimes you need use less debt than more debt or like equity. And I think I don't think like even like every CFO is really well equipped to make like those decisions. And I've seen like so many cases when even the company with like kind of like relatively low debt, just like I know less than 3 EBITDA, but there's a downturn, their revenue is going down, but also it's usually they in relative terms, the EBITDA margin is also going down. So they losing revenue. It means that EBITDA in absolute terms is going to be lower, but they also proportionally, because there's more competition, they need like to provide discounts. Like, I don't know, like their clients don't feel really good, like, and they need like kind of like, I don't know, additional spending or something. And it's kind of like, it goes usually two ways. So they have like revenue decrease or like stagnations, whatever they forecast. And then the margins are deteriorating. And then you end up like, okay, I thought like I have like not really high debt to EBITDA ratio, and now you have like, I don't know, 5 or like, I don't know, around 5, and then you have a high interest rate. So, and then like the banks wants like a high interest rates. And then if it was like, I know how 3 months ago, like so many potential lenders want to take part of your business, they want to finance, and then there's a downturn, like they become like all conservative, right? Like and it's happening all in the same time. So your financials deteriorate on the several levels. You're losing your top revenue, you're losing like your margins deteriorating, and then you have less options to refinance it, and then the interest rate is higher. So, and it's happening simultaneously, especially kind of like in a recession. And I see people kind of, when the times is good, they get more and more debt. Even if they're doing it prudently, like they estimated like everything stays the same, right? That interest rate stays the same, like these kind of like margins stay the same, but it's not, it's just going down. And I saw like really good companies kind of like end up in kind of like almost in the restructuring cases, just like, I know, 3-4 months, and that's it. So I'm very, very curious, like you should be really diligence on your debt and really thinking about scenarios. That's what I love, like to look through the scenarios. Okay, I taking this debt. I know either you're financing a deal with a debt. Like just consider your downside scenario. Like what's gonna happen? Like will you be able at least serve interest and pay at some point principal? Start paying this principal like in this downtown scenario. Like just like playing with this because it happens.
Yeah. There's a couple of things that triggers for me in terms of thoughts. Is that, I mean, first of all, inevitably, and people, don't take this into account. When your revenue drops, your EBITDA drops by a higher percentage because you have fixed costs, right? And you can't always adjust those fixed costs so quickly, right?
Yeah.
So, you could be 10%, depending upon your industry and your profit and your margins, whatever, but a 10% drop in revenue could be a 20% or 30% drop in EBITDA for you don't know, depending upon what your margins are. So that could, go quickly. And then the other thing you're saying, which is really interesting, like, again, analogy, different scenario, but if you ever listen to like Dave Ramsey, he encourages people to buy, like, never be in debt for anything, right?
Yeah.
Buy real estate for cash, whatever. And then there's a whole other school that says, well, that's crazy. You can leverage and you can get, especially when interest rates are lower, you can get cheap money and you can invest it. But the point about it, and my point is not to take a position on that, but my point about it, the comment that Ramsey makes on that, which is similar, I think, to what you're saying, is that a lot of folks, when they make the other argument, they're not accounting for risk. Mm-hmm. They don't build in risk to their analysis at the level that they should. It's sort of like you said, their assumptions are not bad, assuming everything continues to go okay, but they don't take into account what happens if things really go down.
Yeah, and I think it's like, if you look at this, it's just, I think it's crazy to assume that everything is going to be okay. Like, there's no business like that everything goes okay. And I think like it's one of the biggest difference between first-time business owner and an experienced person. Like, the experienced person knows that like it's going to be white and black all the time, and like you need to prepare for those, and you need to build like this kind of safety of margins. I'm not against that. That is a great instrument, but it's just people use it too much. It's kind of like, it's the biggest reasons why businesses are out of the game, because they use too much leverage. It's like nothing can kill you. If you have like a very low leverage, you can sustain any times. You can downsize your company 3 times and went through whatever you have it right now. But like, if you have a very high leverage and you cannot refinance it, you kind of like, you just end up there. And another issue, what I see, it's not like the business owners really don't understand the actual financial standing, like what's they actually making. And it's partially because of the very kind of weak financial function inside the company, and kind of like a low understanding of the business owners in general, like how financials works.
Yeah. And one fundamental difference is the difference between the P&L and the cash flow statement, right?
Yeah, but it's just like there's so many things that are kind of, you need to be on top of that, especially if you're taking loan. Like, why is this the difference? Because if you're running like a lifestyle business, like, and you don't have a loan, you can sustain it. You can, I don't know, temporarily close it. You can like lay off people. You can regroup. Like, you always kind of find a way. If there's a debt, it's kind of like, it's just another game, and you really need to understand how. But real estate is a good example. I think like, if the real estate, again, if it's not highly leveraged, it's a good instrument.
Yeah, I mean, listen, if I've done some, real estate investing and things like that, and the bottom line is, if you can cash flow in tough times, well, okay, then you can sustain the building, right, or the shopping center, or the whatever it is, right? But if you're so leveraged and you're just playing the appreciation game, especially if interest rates adjust up and you have to refinance, or you have adjustable loan, right, you can run yourself into trouble. So I know obviously in different sectors, different industries, the ratios are different or whatever, but just conceptually, how do people, you talk about first-time CEOs versus experienced ones, how should somebody analyze how much debt is too much debt?
Yeah, it's a good question. I think the one factor that is really important to understand is volatility of your income, or like of your revenue.
Yes.
It's one factor that, because these are like really stable, utilities and like telecom, it's one level of volatility of earnings, and you definitely can leverage it more, right? Because it will come. And then there's SaaS business that just starts selling. So it can be volatility of those returns is completely different. And it's the first number, and it defines like, if it's less volatility, you can take more debt. If it's more volatile, I would be very cautious. Another thing is also dependables. Like, I think it shows really, it's overall the health of the business. How diversify your client base? If you like, I usually run like these scenarios. It's like, okay, what's gonna happen with financials if you lose 1 or 2 main customers? Like what's going to happen? Like what's
Yeah.
going to happen next month with your financials? What's going to be the revenue? What's going to be EBITDA? What's going to be the operating cash flow? And can you at least serve your interest rate? Like you should be ready, especially like the businesses that really depends on a few clients, or like the client base is not so diversified. It's another factor. And why I think retail business is more difficult to build, but when you have like, I know, thousands of customers that paying you every month, it's one level of security. And if you have like, yeah, just a few large corporations that can change, like they can stop buying you whatever you're selling, like products or services over time. And yeah.
Yeah, it's interesting, and that we do a lot of M&A, and that's obviously a factor. I mean, when companies get valued for M&A purposes, it's similar to any kind of debt underwriting, or whatever. I mean, concentration risk is definitely a factor, and it definitely adversely affects valuation because it increases risk and/or deal structure, right? Sometimes one of the things we've done, for example, in M&A deals, sometimes is to say when the buyer tries to discount the multiple, the valuation on a concentration risk, we say, wait. Don't discount the multiple, because what if if all the clients stay, then you're undervaluing the company.
Yeah.
Have an adjustment provision. If we, all right, you concerned about these two clients? Fine, give us the multiple we want, but then we'll agree to adjustment provision if within the first 3 years or 5 years or whatever it is, we lose that revenue and we haven't replaced it. That's the other thing. We always give an ability to replace it. So sometimes there's an old joke in deal making and M&A. You give me a price, I'll give you a structure. Give me a structure, I'll give you a price, right? Yeah. But there are sometimes there are ways to avoid losing valuation on concentration risk by how you structure the deal.
Yeah, but there's another thing that I see. It's kind of like it's still hard. Like it's kind of like then you can follow up with certain legal actions, right? But it's costly and it's kind of like it's not the best remedy. And yeah, it's just like, and yeah, you still can lose it, right? Like I don't know. Yeah, 3 years is good, but I see like sometimes it's 1 year warranties, and then it's kind of like it's on yours. Yeah.
Let's take a break from the show for a minute so I can tell you about an incredible resource my team and I have put together for you. Secrets of Deal-Driven Growth, Creative Ways to Grow Your Business Even in Challenging Times, is a powerful ebook that helps you take DealQuest podcast episodes and apply them to your own life and business. This is the ideal tool for anyone looking for creative ways to grow as deal makers, and you can get yours now. It's as easy as heading to coreycupfer.com/workbook and downloading your copy. While you're there, you can also consider joining our dynamic deal-driven community of founders, experts, small business owners, and entrepreneurs. Now back for the show. So, you mentioned volatility before, and you talked about how that, can affect risk and lending. Well, interestingly, right, you got into the crypto investment fund in 2017, comparatively early. Talk about an industry that has some volatility. Tell us a little bit, about what you're doing now, and being in the crypto space for what's comparatively a long time, considering the length of the crypto industry.
Yeah. No, we just started investing in the projects in 2017. Then there was like ICO boom. I don't know if you remember. It's kind of like when it's like first time I think reach out the media streams and like people learn about it. It's like the crypto. Yeah, we invest in a lot of ICO projects. Like I think 90% of them just like didn't deliver. I think like went to zero. But some of them make like some of the returns was like crazy, like 50x, 100x. So yeah, it was really good time. And yeah, like over time, just investing in early stage, like seed, pre-seed projects, like blockchain based projects. And it was an interesting time because unlikely in a venture deal, there's a way shorter period after you invest, and then you have a liquidity event because you have tokens, tokens for the most projects, and it's kind of like it makes everything simpler in terms of investing. And I actually wonder why like so many VC still don't invest in crypto, because it's definitely a huge advantage over other like venture sectors that they usually invest. Because like I know what's now average holding period, at least 7 years. Like, and yeah, it's just
that's so much quicker. Yeah.
It's kind of like it becomes longer, and like the holding period is longer, and there's a longer wasting schedules and so on. But it's still like 3-4 years. It's still, I think it's still shorter comparing with the On the other side, yeah, you probably can sell like a secondary if it's a successful project in venture, at least partially. But you also can do the same in crypto projects. And there's actually, I think, like even more liquid market for this.
Yeah, it's super interesting because I mean, you say, like why did more, ventures, investors and others get into crypto? I remember, so I've been around for a long time, and I remember a time when a lot of the VCs were not like, I remember I had a client who, what they did was they delivered reports on schools and school districts to real estate agencies. So people would go in and they'd be thinking about living in Greenwich or Wilton or whatever, Connecticut, and they say how are the schools, and the real estate agents would be able to deliver a report. And in the beginning, that report was faxed. Okay, we're going back a long time. It was,
Yeah.
the request was faxed, and then the report was snail mailed,
Okay.
right, to this is what we're talking about. It was in the 90s. So then the internet came in, and I remember I had a client back then that had a VC investment. And when the client was smart enough to understand he was in the information business, said it was going to all go online and he had to get on the internet. This was a major VC fund. They refused to give him additional capital because they weren't investing in internet back then. Like the internet was this new thing. It's, sort of like crypto, and, they weren't investing in it. This is a major, VC fund at the time. So, I've seen this before. It takes a while for some folks. Obviously, there are some that, are much more on the cutting edge, but then, it takes a while for a chunk of the market to.
Yeah, I understand. And I think like regarding the crypto, there's a certain regulation. Like I still like, I remember like this conversation, even family offices, they just like don't want to touch it. Just like there's no really risk for them, like just to buying like a certain digital assets, but they don't want to do this. Yeah, just because like there's some regulation, legislations, uncertainties.
Yeah. Well, and the other thing you said, which is interesting, is that 1 in 10 investments really took off. But, the thing is, and we've talked about this on this show in the past, the truth is, if you look at venture funds, PE, investment fund investors, that's their entire model. They usually, even outside crypto, they rely upon 1 in 10 investments to, they say 7 go to nothing, maybe 2 do whatever, okay, but it's really the 1 in 10 that they make all their money on.
Yeah. It's usually 1 or 2. Yeah. Like when they model the portfolio return, it's kind of like, one should be kind of like a blockbuster, another kind of like, 5x. And then they're expecting like, 2-3 return like the 1x. And then, they write off the rest. Yeah.
Yeah, the other side.
I remember like speaking about this is just shortly. I remember these bizarre conversations with one of the business owners. And so he was been working on this project for 5 years, and he VC back like a few rounds, and then he had this proposal to buy his company, like the entire company. And like for him, it's of course like was like a kind of like a life event, right? But for VC, it was kind of like 1x return or something, and they basically blocked this deal because they said like, for us, it's kind of like it's easier to write off it than get 1x. So we either will sit with this and like see like what's happening, like then just get right now like 1x. It's just like it doesn't make any sense. So like we either write off it, and it's actually what's happened. Then they kind of like they went to this long corporate conflict, and the company they just shut down the company.
Wow.
Yeah.
Yeah, because they're going to push them either to get much higher returns or to go out of business, right?
Yeah. So, and this particular, I met this business owner on the event where he describing how you should structure your board of directors. And because he lost like the majority on the board of directors, and they will be able like to block this. Yeah. Well,
and listen, that comes up a lot with folks where, usually not on the first round of investment, or maybe even not the second, but this goes into understanding your capital needs and, and this balance between, I always say this to my clients and my friends. I'm like, you always have this tension between when you pitch to investors, wanting to show them all this upside that they're going to get, but then they're going to hold you to, covenants and triggers to meet that. If you don't meet it, then they might have ratchet rights, or they might, get additional board seats or things like that. And that's how you end up losing control.
Yeah.
So listen, any other stories or things? I mean, you have, you have an interesting background in having such, experience on the lending side and on the investment banking side, and now on the crypto side and investments, fund investments there. Just in general, any other big lessons that or mistakes that people make?
I see like people relies a lot on the financial audit or even on due diligence. And I can tell you like there's so many ways how you can obfuscate the financials. And it's kind of like I'm talking about only legal things. And like there's so many things how you can, I don't know, book your expenses as a capital and then it's not show up on a panel, or like how you like hide certain liabilities. And just like there's so many things. And I really, really encourage like go through and like especially like the revenue, like make sure that this revenue exists and like those customers exist and so on. There is a story like we're reading on Wall Street Journal like this. Another credit provider like went bankrupt, right? Like we have already so many stories, and you see like even like large financial institutions cannot due diligence it properly, and there's usually something. They always something. It can be small, but you know, like the seller of the business incentivized to show you the best picture possible, right? And they will do like whatever instruments they have like to show you a better picture, right? And there's so many stores like when like, oh, they know like they're gonna sell this business, they kind of like, I don't know, maximize the EBITDA, cutting certain things that they can cut, but they know it will come back later, like long term, but because they selling, they don't care about it.
Yeah.
And I think another thing, I think like so many founders, like or business owners, don't really understand it. And like I've seen it so many times, like working capital. If you don't have these provisions about working capital, you're not really understanding what you're getting in terms of your working capital. You really need to detail it in your purchase agreement, like all your docs. It's because like I've seen so many times like when like a seller just dry up like this working capital, taking everything possible, like it's crazy. Like I don't know, like a test drive cars, like everything possible they taking home. Like
Got it. I know this is like a big question, but being in, I think in terms of crypto, I think there's, well, maybe three categories of people, let's say. There are the people who are into it. There are people who are fascinated by it, but are not into it, right? And then there are people who write it off or reject it, right?
yes.
But listen, you see major institutions getting into it. You see more regulation coming in. These are all the factors that indicate it's going to be around for a while. Interestingly, there are also some of the factors that the sort of true believers in crypto and in a decentralized, unregulated way to have, transactions and currency or blockchain, any of it, some of them bristle at the fact that it is becoming more institutionalized and more regulated, right?
Yeah.
So, any particular sort of trends or things that you see that you think are particularly interesting right now in the crypto space?
I definitely see it's kind of like if you ask like what's the biggest application like use case of the crypto, you can see stablecoins, and I think still very few people really understand the already like these are, I think like the volume of transactions in stablecoins already kind of like in trillions if I'm not mistaken. So it's huge. It's already like a huge market. But if you're in a developed country and you don't really have like, I don't know, like you don't need to transact with other countries, you're probably still like not aware of this. Like if you like, and it's big. And I think like this topic of programming money, when you can just put like so many different conditions, terms inside the contract, and it's being executed, and then you have like a stable coins as a dollar just like to settle this transaction. Like the potential is enormous, and I think we're still very early. Like, when I was joining crypto, I thought I'm super late. I thought like everybody knows about Bitcoin. Like I thought like, what is my age? I was thinking like it's already in the news about Bitcoin. Like what is my age? Like what I know? Where's my alpha? What I know that others don't know? Yeah.
Listen, I know there's some portion of our audience that knows exactly what stablecoins are, but there's probably a lot of folks that don't. So can you give us a little primer on stablecoins?
Yeah, it's basically like this token, like these digital representations that match $1. So basically, it's unlikely the rest of the crypto market. It's stable, and it's usually around like $1 or $1. So it's not like Bitcoin. If you hold it, it's like today it's like I don't know 100,000. Tomorrow it's something completely different.
Yeah.
it stays the same. There's a number of stablecoin issuers. The one is a Circle that is a public company right now, so I think it's free to use it. It's a regulated company. It's based in the United States, and these are recently the new regulations regarding the stablecoins. So I think stablecoins, in terms of regulation legislations, they don't have this like enormous risk right now. I think like you easily can use it, hold it, and it's stable in value. So it's $1, and then you can open up like so many use cases that how you can utilize this stable coin. So I believe we're gonna be at some point, we definitely will switch to the stable coins execution. It's just faster. I remember like 2 years ago, like Goldman Sachs said that, I think CEO of Goldman Sachs said that they switched to settling bond transactions using blockchain technology, like private blockchain, and then they settle transactions within like a few minutes instead of like 3 days. And it's coming. It's just like blockchain is just like so good for the money transactions, so it's just way more convenient.
Yeah. So my next question was going to be, what are some of the advantages? Clearly speed, a much quicker settlement opportunity is one of them. What are the other advantages of using the stablecoin versus?
Like there's so many, like for example, fractionalization. Right now, we cannot send like $5 or like, I don't know, like $1, like the transactions fee is going to be very high. We cannot make like this kind of like programmable money. Like, I don't know, like I send you one money, but then it's sent to another address if certain conditions made or certain conditions not made, like, right? We still like, we're doing this ACHA wire and we're waiting for a few days, right? So even like this thing, and then, yeah, we kind of, like there's so many cases, like I know, for example, I providing a service for the client, and like I just send an invoice and then they pay. So like in the future, it's going to be just a contract, and then there's going to be just the confirmations that I've done my work, and then I send these confirmations to the contract and I receive my immediately. And it's not dependable on human judgment. And there's so many use cases, like a lot of like trade finance all based on the letter of credit, like all these transactions. And crypto is absolutely, it's so good to build this. Right now, the letter of credit, it's still up to the bank, like to issue the money. They still kind of, and there's a kind of, and you can have like a 100% certainty if you put it on a blockchain.
Yeah, it's so interesting because there's so many ways that it's going to change business models, but people don't realize, whether it's banks or whether it's some of the payment apps, right? Whatever, the PayPals and the Zells and the, whatever, like how much money various businesses just make on float.
Yeah.
Right.
Yeah.
And just that, if things settle out right away, well, that's going to, that's going to affect that piece of the business model.
Yeah. And it brings efficiency. Yeah. And I think accessibility, like there's so many people still kind of struggling with the bank accounts, especially for developing countries. I know, like it's kind of like, yeah, it just open up so many use cases.
Yeah, it's interesting to me in developing countries because you've seen it in other technology where they sort of skip steps, like where places went directly to cell phones because they never built a landline, infrastructure, and they never had that. And then it was, once the technology came, it was much easier for them to adopt that. So, they get to it's very interesting in terms of just world development, things like that, where sometimes technology allows entire regions or countries to just sort of skip development,
Yeah. I think like in China, right? Like everybody uses WeChat to pay, right? And it's kind of their versions of Apple Pay. They completely miss like one part of the development, like these credit cards, debit cards.
Right. Yeah. Fascinating. All right. Before I get to any last thing you want to mention or say about either, what you're doing or anything else that comes to mind before I ask you my final two questions?
Yeah. I'm helping business owners to run more efficiently their business from the lens of financials. And especially if you like 3 million of revenue and more, there's certain things that your accountant or bookkeeper like don't really know, and they can really advise you on your financials. They are not financial people per se. So
yes.
Yeah. Let me know if I'm happy to consult or happy to advise. Yeah.
Great. So that's a perfect segue. So if people want to find out more about you or reach out to you or find out more about your services, where do they go?
Yeah, my website is thesorso.com, the Sorcerer. So yeah, you can schedule, we can find, I write every day on LinkedIn and X about financials.
Excellent.
Yeah.
Just as my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for people from oppression to why I've been an entrepreneur for decades. Certainly some folks in the crypto blockchain space talk about freedom as well, just to add that in, because I know that's an ethos that underlies some folks who are into this, and for them, some of them it means freedom from decentralization, whatever. But in any case, what does freedom mean to you, and how does it impact your life and business?
Yeah, it's actually like, yeah, for me, it's also the main kind of value that I'm making like most of my decisions, like, and yeah, it's important. It's very important not to be constrained by certain things and just do whatever you want. I think it's super important for us. Yeah. So, and yeah, crypto is actually one of the ways kind of like we remove gatekeeper on the money aspect, and it's very important. So it's kind of like, if you think about right now, like the United States, like there was like previous administrations, they kind of trying like to kind of like stay away like a crypto companies, for example, right? Like they're struggling to open a bank account, and I think like, I don't know, I think it's just too much. I think like you should have rights like to access to the money, to transact in the money, right? Like yeah, if you did something wrong with the money or like you participate in illegal activities, okay, but it's a different thing. Why are you punishing like for nothing, right? Like, yeah, like I really respect the freedom.
Love it. Stas Sukhinin, thank you for being such a great guest on the DealQuest podcast.
Yeah, thank you, Corey. Thank you very much for having me.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.